under which tokenization could easily be applied. And we were saying, why doesn't the SEC, when you hear these discussions from the SEC, there's two discussions. One is cryptocurrency, right? And they say, well, we don't understand what cryptocurrency is. The other side is unregulated securities. So, as we said, which is it? It's either cryptocurrency, which falls under FinCEN, right? Currencies are regulated by FinCEN in the United States, or it's a security. And if it's an unregulated security, those unregulated securities could easily be brought under regulation rules of either A or 506C, Regulation D, or Regulation B, in which case you have institutional investors or retail investors.
Let me break it down simply. Money goes in a bank, stocks go in a different system. If you trade stocks, you're buying and selling stocks, you're using stocks to raise money. Currencies are what banks do. So the distinction of wording comes down to currency, payment, tokens, using tools as a way to raise money technically falls much more under using it as a stock or a security or equity versus using it as a form of payment.
Yeah, they definitely need to create new definitions or to edit definitions, because now you have new tools like an NFT, and then lawyers are trying to find really creative ways to prove that it's not a security. And the latest one that I found was, securities need to be fungible. That they're, by definition, a security, there's a multiple of them. And that's something that I think could be challenged, right, by the regulators. If you're blatantly raising money from people for the purpose of value creation, because it's going to go up in value, in my mind, it's a definition of a security. So they definitely need to update. As far as the Jobs Act, we've been trying, so my company, SolidBlock, we tokenize real estate, mainly in the US. But we've been trying to bring or convince the regulators here in Dubai and in Israel and many other places that they need their own Jobs Act. And there are several ways in which, due to the Jobs Act, this industry of private security offerings has blown up. One is because you don't need to register security with Reg D 506C, as long as you take money only from accredited qualified investors, which in the US, it's very easy to prove and is required. It's upon you to prove that you're accredited. And the second way, which no other country, to my knowledge, in the world has allowed unlimited solicitation without having a registered security. And that has blown up. The industry has blown up. You can take out an ad in New York Times as long as, at the end of the day, you don't take money from what's called retail, right? Retail investors. Now, most other places in the world, you put your trust into regulated the regulators put trust in regulated institutions, exchanges, ATSs, that they need to make sure that all the rules are complied with. And unfortunately, that's all the new regulations. Some of the new regulation that I see here in Dubai is also following that stand. So let's lobby.
Yeah, I agree. I think in Dubai, one of the things that we recognized is you've got sort of the major market, right, for securities. And major market meaning you've got like Mahabdallah that's going to write a $100 million check. Now, when it comes to startups and middle market, lower middle market companies that are looking to raise $1 million, $500,000, $10 million, those companies don't have anywhere to go. So what do? Hey, bro. Hey, bro. Right? So it's the hey, bro market. It's an unregulated market, and that's how this sort of cryptocurrency, quasi-security market is evolving here. Not to say that it's necessarily bad, but it does need some focus, and I think an example is the Jobs Act for UAE or for the region. It could be a really good application for the area here.
And we'll talk about it in a minute. We helped with the VFA, the Virtual Financial Asset Laws in Malta, where we tried to create blanket terminology. The good news is, unlike a plane, we have more people showing up. When the plane's gone, you can't come in. So we just had Dan join us. little bit to make your way across. Just give an introduction and we'll jump you right into the conversation.
Sure. Sorry about being late, guys. Just got in today. My name is David, founder, partner of OP Crypto, a venture firm that helps really some of the best Western projects go to market in Asia and vice versa. Have tons of connections within the Asia market. I previously was leading global strategy and investments at Hawley, so worked there for about 4 years, leading up the exchange business as well as all of the investments out of that vehicle.
And what we've been talking about is using blockchain as a technology across different terminology and different types of funding. And let's talk internationally for a minute, because as a U.S. company, technically, a U.S. company can't use tokens as a way to raise money because, to the point, it's not a security, and the U.S. doesn't quite know where they're going to land. Internationally, there's no such restrictions for an international company using tokens as a type of fundraising. What strategy did you guys put in place early on in the exchange, and what have you seen evolved over the last year to year and a half?
So I think for the exchange business, ultimately, the main goal of the exchange is to provide as many valuable assets in the form of tokens, because that's the only thing that we're able to list is to the hands of as many people as possible. When Hobby first started, only had sub 1 million users. Now it's serving over 30 million users across 170 countries. And it's really the job of the exchange to find all the best tokens out there in the market. And for some of that, that means to invest in the projects before they're ready to be listed so that we can really monitor the progress of the project, give it not only the capital sources that it needs, but ultimately all the different resources, whether it's community building, whether it's like technical resources, whether it's like all the sort of liquidity support that it needs before ultimately listing on the exchange and making it available to all the users of the exchange.
I just wanted to give you a small distinction. A token is just a representation of an underlying asset, right? In terms of cryptocurrencies like Bitcoin or Ethereum, they are Bitcoin, I guess, they are the underlying asset. Ethereum actually does have kind of amalgamation of different things that are on the system, technically, supporting it. But, in terms of raising money for a token, you are raising money for whatever asset is under it. It could be equity, it could be commodity, it could be, usually there is a special purpose vehicle that's corporate. So most likely it's equity stake, it could be debt. So there's a lot of things that could be under the token, and you are allowed to raise money with tokens in the US. Most of the stand of the SEC that whatever you have is likely a security. So you're doing a securities offering. Just have to figure out which one.
The distinction also is, again, it's level of investors. Have any of you ever been an angel investor before? I joke, and I like making the contra. I'll never be an angel investor again for equity. You're like, well, what do you mean? I'm like, I have no optionality. If I put 25,000 in as an angel, I'm a 92% chance of losing it. So right off the bat, I'm already at a negative. If the company starts doing a little well, it'll raise some more money, and I might be able to reinvest. And if they do better, they'll do what's called a Series A, and I'll get diluted. And if they do better, they'll do a Series B, and then the greedy venture guys come in with what's called triple liquidation. So they get 4 times their money out before the little angel. We get squeezed. If somebody offered me a token as a representation, even if there were no liquidity, if that company started doing well, if they started getting markets, if they started building liquidity, the investor's actually better protected with a liquidity structure of optionality. But the evaluation at the startup level is different than a mid-stage and much different than a big stage. And I'm going to go through that real quick because you do more institutional, traditional, Yael's kind of in the middle, and then you're on the exchange side. As you see the market grow, I think there's room for both, but the usage is going to be different. The startup companies are going to do offerings one way, and the institutions are going to look at it differently.
Yeah, well, I think we've got we've got to take it from the investor perspective, right? And the retail investor perspective is let me get in, make as much money as I possibly can as quickly as possible, and get an early exit, right? And that's basically what crypto is, right? You're in quick returns out. That's the majority of what crypto deals are. And institutional, us as an institutional, U.S. Capital's perspective as an institutional, we're growth stage. You know, so we're looking to come into something that's already evolved into revenue positive. So when we're thinking about building a product, a security product, we're looking at building a security product relative to our position in the marketplace, right? Which is at that growth stage. Now that may work as a private market security. It may also work very well as a public market security if the strategy within a short period of time is to IPO, right? So where an A plus makes a lot of sense, right? Where you come into an A plus security, 18 months later, you can IPO.
Go ahead.
Yeah, so what essentially we're talking about is that all these tools are kind of like staged steps to going public, right? You don't go public on day one. Like you have all the, you go to an angel, then you go to a seed stage VC, then you go to a later stage VC, then you go to US Capital, then you do a Reg A plus, then you do an IPO, right? In the ICO world, you kind of jumped into the IPO from the get-go. So, and to your point, Stephen, it would be really, really nice to have it regulated and also to have a tool which allows angels to automatically get liquidity at a later round, right? When these guys come in, you get out and you get, you have an opportunity of an out. So, but my biggest question and to myself and to my industry of the security token would be, when is the right time to actually issue a traded security?
And I'm going to answer that before we transfer back to the exchanges. If you look at the U.S., again, I'm not saying U.S. is the best market, just there's some classic structures. IPO is long-term, $10 billion, billion-dollar revenue, $22 average stock price. NASDAQ, little bit lower, little bit more risky. Over-the-counter are what are called penny stocks. In Australia, it's ASX. Toronto, it's TSX. That's the low-cap speculative. You don't actually do an IPO in the small-cap markets. You do what's called a DPO. It's a direct public offering because you're marketing to your shareholders or your customers. So a direct public offering is really much more what the crypto world does. It's a direct offering. And then we turn to IEOs for a little bit. The only difference with an exchange offering is the exchanges we're going to help promote. But the distinction, I think, for startups is a direct public offering is build an audience, build a community. That's where the Telegram communities allowed you to communicate directly with an interested audience, and you couldn't do that before. So if you bring an audience to something like an exchange, you've got liquidity. It's a direct public offering, and that helps us move downstream to not conflict with later stage companies. Does that make sense? And what do you think? The exchanges I know have done early projects. Do you still look at early projects, late projects? Where do you think the evolution is going to go on the exchange side?
Yeah, definitely. So I worked at Hawley for 4 years as context. So now I started actually a new venture firm that helps leverage some of the resources I have at the exchange and my expertise of seeing all of these projects go through the exchange business. But I think the new next iteration of projects coming through the exchanges are all like the people that are driving the efforts before it even gets listed, right? So it's like venture capitalists like mine, late stage growth companies like, our other panelists here, and even the angels that were supporters early on, plus like the influencers, that everyone is sort of all pulling together everyone's resources to not only bring the best traction to any particular project, but giving it the capital that they need, giving it all sort of the resources that a project needs to be successful post-listing, right? So I think listing at earliest stage level is really taking a composite score of a project, looking at all different metrics like valuation, like market traction, like the previous investor networks and its current sort of community itself. But all of that is sort of needed with the help of every single investor and supporter and developer along the way.
Let me start here and then we'll make our way back out as we close. So as a venture investor, VC, are you doing equity? Are you doing tokens? Are you doing combination? And if you are doing tokens, how do you calculate valuation models and things like that? Because it's not a traditional equity cap structure, it's a priced model into the marketplace.
Sure, sure. So as a venture or crypto token fund, I only focus on more of a token native project. So I think ultimately, like when we think about tokens, it's a form of ownership that is very much programmable, interoperable, and easily transferable, which is much better sort of form of equity as it stands, right, in the crypto native world. So I think going forward, maybe 3-5 years down the road, there wouldn't be as much equity type of raises at all from even like venture capitalists to capitalize on in the crypto space, because eventually everything will move into tokens. And the only form of equity we'll see these days is that, like before they really figure out the right tokenomics or right crypto native structure, they start out as a safe, right, for like future tokens or like SAFs, right? So like ultimately we get a skin of the ownership in form of equity, but eventually that will be converted into tokens. As sort of VCs in the space, how we think about valuation or how do we think about the right pricing of a project is all relative comparables, right? Like what is sort of the project at, what is sort of the market sizing or the market opportunity it's looking to tackle, and what are some of the comparable projects that's looking to do similar things in the space, and what are sort of the market caps of those players, right? So I think with regards to valuation itself, we no longer can really take sort of like the price versus earnings ratio or like, you know, a lot of sort of the traditional finance metrics that we see in like private markets, venture capital, but more so much more comparable driven and much more sort of market sizing driven.
And that's why I asked, because equity, valuations, those are fluid, unlike real estate. So now when you go to tokenize a real estate, you've got a qualified asset with a set price and valuation. How are you using the tokenization with a structure around a classified asset that's got a set value?
So I'll address that, and then I give you a few points on like a VC structure as a contrast. But in terms of real estate, whether it's a real estate investor that's putting in the money, it could be an organization that wants to diversify their capital stack or their investments, like a corporation that has extra cash. They might put money into real estate. It could be a fund. It could be a variety of situations, right? So when we do real estate tokenization, of course, it's based initially upon appraisal, like traditional real estate appraisal that makes it, you know, an asset class that will fluctuate with the market, but won't fluctuate too much. So it's a, you know, different risk category. So that's in terms of the real estate token. That's usually, if we have we can still have derivatives and structured products, which will be fluctuating more, right? If you have a fund, let's say, you know, let's say, distressed assets and stuff like that, it will be a high-risk fund, right? And we'll have more fluctuation. Now, you asked about the VC or a more institutional capital. What's really interesting about them is that now most of them don't invest in just tokens anymore. A lot of them are investing in a combination of tokens and equity. And the reason why they do that is because they're de-risking their own portfolio, right? Even they cannot withstand the amount of fluctuation that they have, right? So they need to always, there's several analysts you know, employed by a fund or a VC that will calculate at any given time the risk structure of any portfolio. So, you know, and I think it's very smart that lately they've been combining the equity and the token.
I wrote a paper on that, not a white paper, just a theoretical paper when this was coming together, and I call it a toquity.
Like
So
that.
I tried to use the term token and equity as a toquity round because there's benefits for both. They're different, but yeah, so I created the term toquity. If you guys ever see it, you'll know. But Joshua, wrapping up for us on anything?
Well, I'd like to just mention on the VC side, we still see companies, or at least I'm seeing companies, VC companies that are investing in tokens, but they're using a totally different model of valuation, which is entirely around protocol and technical audits. So that's something that's evolving, right, that's exclusive to this marketplace, right, that has nothing to do with sort of the traditional public market securities. So
And I think that was the point we were trying to make overall on the panel is blockchain enables you to do a bunch of different things. There's no one size fits all. So you've got early stage capital markets, you've got middle market, you've got late stage. The valuations, how it executes, what the rules and structure sets are going to change over time. But that's the great part about the technology. We're in the frontier of building it. Just help all of us. Let's fix terminology so we all kind of say the same thing. But appreciate everybody for coming. Thanks for filling up. Finally, we started with 2 people. We ended up with 30. So that's
great. You have a whole bunch of people here. Thank you very much.
Thank you.
Stay there for a second. So we'll open it for a couple of questions. But I have a question for all of you. So we have lithium mines right now ready to be tokenized, and we have real estate ready to be tokenized, top level, only top level projects. So my question to all of you, which is useful for the public here, is what are the specific steps, given current regulations, given what we know today, to tokenize real estate globally and lithium mines globally?
I have one question before anybody can answer that is where?
In Chile.
Okay.
Okay. So I'll give you the steps. The first step is to ask where the investors are going to come from. It's not going to be a global offering. It's way too expensive. Let's take US and let's take Dubai, okay? Let's take US, South America, and Dubai. In the first step is to create a special purpose vehicle, because you are not going to be putting investors straight into the asset. You're going to putting them in a vehicle that owns the asset. It may even own a company that owns the asset. So now that vehicle will have an agreement to buy the asset. So you create an agreement. The Chile mine company, right? It will buy the asset as soon as the money comes in. That's where the smart contract comes, right? The next step is for you to create all the legal paperwork, all the regulation. In America, you have to have a PPM, a private placement memorandum, and you have to do a Form D for Reg D 506C to do accredited investors, and to get retail, you need to do a Reg A Plus, or Reg CF, crowdfunding. Once you're done with all of that, you can go out to your investors and start collecting the money. To collect the money, you might want to open an escrow account. It's recommended. Now, once you collect the money will go towards buying the security. You're going to get your token, so as per the smart contract. So the smart contract will be released as soon as you collect the sufficient amount of money, and then the smart contract is going into your investor's wallet, right? Most of the platforms like SolidBlock have a managed wallet solution, so you don't have to actually have your passwords and all that stuff that the crypto investors have to deal with. We'll do it for you. So that's US. In Chile, there are different type of regulations. In South America, the last I heard is that you can market freely, but there's certain ways, certain regulations have to follow. In Dubai, there are different jurisdictions as well, but you might have to actually launch your security on a stock exchange in order to comply. So, that's basically the process. And then you connect it to an exchange that is licensed to trade. So
That's perfect. Joshua, you want to say anything about it?
Well, I think Yael did a very good job. I would say why? Why would you want to tokenize? What's the logic in tokenization? How much assets do you have to begin with?
$2 billion worth of lithium on the ground right now.
In the ground.
Yeah, with geological studies and everything.
So that's a very difficult value proposition for a traditional investor. I mean, if you're talking to an institution, they're going to immediately say no, because it's an in-ground asset. How do you qualify an in-ground asset? If it's gold and it's in-ground, it's like a 10-year process to qualify that valuation for capital to come in. It's not an easy process.
That's exactly why I'm asking the question, because I know it has certain steps.
So I think if I were to say or give an advice, I would say that probably an A-plus style security where you go to the public market and sell to retail with the hopes that maybe 5 years down the road that you're going to actually get that asset out of the ground, that'll give you a capital base to then raise into later stage rounds. Maybe you do a couple debt series, et cetera. But that would be my advice.
Yeah, anything else?
Again, you've got a traditional asset, so you're trying to use tokens as a traditional asset, which is traditional financing, when the token market's not traditional financing. Most token projects follow the same 5 Ps that over-the-counter penny stocks are successful on. Not all of them, but you need a product, then you run press. So you run press, then you hire promotion. The promotion people reference the press. Then you attach a personality who gives you free press, and you move to profitability. Like that's the execution through a penny stock. That's the execution through most tokens. They're trying to generate press and hire a personality, and a traditional finance in the token world they haven't quite married yet. So I think tokenizing, buried assets, I think is difficult because the crypto investor market doesn't want a mining company that's not sexy or doesn't have a TikTok star attached to it.
It's very sexy, I tell you. But anyway, so we have a couple of questions. We have fantastic experts here on the podium. Would you like to have a question?
Thank you. Hi. Every time there is a talk about cryptocurrency and regulation, there's this feeling that lots of different things are thrown in the same bucket. Whereas in cryptocurrencies, there are so many differences at the moment. It's not about just Bitcoin and altcoins as like your traditional division that would be understandable for the general public. But of course, there are so many different implementations of the blockchain technology in the form of tokens, right? You have NFTs, you have governance tokens, you have stable tokens, you have CBDCs, which are probably not blockchain. You have, of course, the traditional, Bitcoin and all the other ones. So, do you feel there should be like a differentiation in terms of terminology, that cryptocurrency is not just like one term, it's actually different industries?
I will answer that in a polite way, that if you had been on time, we covered all of this.
I was
You were.
Was
one
here
of
from
the
the
first ones.
beginning.
Yeah.
Oh, so we talked about this, that blockchain's just the technology. Sorry, I didn't mean, cryptocurrency is such a broad term that it doesn't do a distinction. Like some things are forms of payment, some are forms of currency, some are security, some are stocks, and even at stocks, there are different levels. Even NFTs, most people think NFTs are attached to a piece of art. We helped do NFTs with one of the bands that wrote a rule set. It's a smart contract with a set of rules that says you can share music, but to unlock it, you have to join a fan club. So I think, again, the early days in the industry, calling things an ICO, relating it to an IPO, was a mistake. Calling everything cryptocurrency, the banks are trying to figure out how to regulate cryptocurrency when they need to look at most of them like a stock. And banks don't hold stocks. They're different. So we totally agree. The distinctions need to start being made for the industry to grow properly and more efficiently. If anybody else has comments.
I am all for it. Let's coin some names. I was thinking maybe asset-backed money would be good. Somebody coined stable coins at the end of the day, right? And they're not so stable. They're largely deflationary right now, the ones that are backed by US dollar, right? So we want to do asset-backed money. Say there's a bunch of mines in Chile, and if anybody is interested, we'll create a fund and then back it up by money. It might be interesting, it might not be, right? But I do think it's important to make a distinction for people that are starting out and are coming in. And what is Bitcoin? Is it an investment? Is it a form of payment? I think by now most people understand. And I love the example you gave about Bitcoin used as a legal tender. It's not a currency. So I'm all for it. Let's throw some names.
And again, people talk about cryptocurrencies being digital. All money's digital. Your debit card's digital. Your wire transfer's digital. It's digital like a train in the 1800s, where programmable blockchain's digital in a train that's a bullet train. They're both digital, just the new technology allows you to do things faster and fundamentally different. with sets of controls that are both good and bad. Controls good and controls bad, and I think we're in some convergence on that area, but totally agree. Distinctions are super important.
Hi guys, thanks for talking. As someone who's pretty new to cryptocurrency, I'm used to investing in traditional things like stocks and shares and some investment funds and things, and I'd like to get more involved in crypto. I already am a little bit investing here and there in stuff, but I hear a lot about the features, but not the benefits. So I hear about tokenizing, but I'd like to know more about what are the benefits of this. You know, what's the benefit of that? It seems like the industry is growing at such a speed that initially things appeared to me to be as clear as mud, and now they're getting less and less clear as time goes on, as we're talking about all these different types of coins, types of currencies. I look at Bitcoin. Is it a store of value? Is it a currency? I know El Salvador's taken it. I'm trying to understand how that's legal tender because the price is so volatile. I think as someone who's new, I want a kind of a more simpleton way of understanding really the benefits of the future.
I have a simpleton answer for you, but we'll close with anybody else. Anybody have an answer? Joshua?
Sure. I mean, I think to go back to the earlier question, I mean, that's how we know that we're still super early in this space, is that we use crypto to reference everything in the space. It's like when you go look at in the Web 2 internet space, no one refers like, are we sort of revolutionizing the internet? There's very many different types of verticals like social media or like, fintech, all of these sort of different verticals that ultimately internet is now, making things more mobile, more easily accessible, right? So I think for crypto, it's the same thing, right? We're first taking that sort of cross-border element into being able to transfer, any sort of storage of value from peer-to-peer, no matter where you are in the world. It's instantaneous transfer, as well as like the ability to unlock, value outside of like the siloed investor network to the retail. Like anyone that contributes to a particular protocol or network, they get sort of a form of tokens where they enjoy the upside of that particular platform and they can contribute to it, right? A lot of it is really about diversifying the method of, accruing value, right? The network effect.
I'll give you a simple answer. I taught sales training and financial services for 10 years. Think of it like your risk profile. Is your risk profile low, medium, or high? If you had $10,000 and you say, I want to put 25% in low risk, 50% in medium, the other 25 in high, think of it as what's your risk profile and then find the assets that fit under. Like trying to pick one, if you're new, just say, what's my risk? And if your risk is high risk, go early stage tokens. If it's medium risk, take a Chainlink or an EOS. If it's long-term low risk, take a Bitcoin or Ethereum. So just look at it differently like risk profile and don't try and figure out everything underneath it.
All right.
I'd like to give an example of I'd like to give an example of an actual application, real-world application for public market securities, cap table management. There was a case several years ago, I think it was 2014, where Dole Public Foods went private. And in the cap table distribution, there was an error in the cap table, in which case tokenization would be a very good example. Huh?
We're over on time, so just, I'm not cutting you off, just make it as quick as you can.
Yeah, so that's an example where you can have an application of public market securities for cap table management. Likewise, in any other application, securities application in general, cap table management, I think, is the best case for tokenization.
Okay, so listen, this is a lot of knowledge. You have them all here this afternoon. You got some questions. Thank you very much for this panel. It was very, very good.
Thank you.